calendars out. February 17th, February 18th, live trading, San Diego. We got the Lowe's Coronado. I mean, what else would you want? This event is limited to 50 people. Look at your calendar, clear it, make sure you show up. If you want to be a rebel, this is the place to be. You got to sign up for it now. Giddy up, baby.
Hey, good afternoon once again, Market Rebels, and to all of our YouTubers out there. Kind of a blah day today, Stu, in the markets, huh?
A little up, a little down.
Yeah.
I think we closed up maybe 0.5% across the board.
Yeah, it was kind of weird that a couple of days ago we had what's called a meeting lines that had a nice big green candle, came back, gave it all the next day, and we've had a couple of gaps, and it looked like it was going to continue and gave it all away today. So
gave it all
more
away.
More volatility in the markets.
We are all dressed up but nowhere to go, I think is the term, Bill.
Exactly. And so anyway, more volatility, more of what we are trying to teach here on Coach's Corner, give you a different perspective on markets, trading, and to just make better traders out of everyone. So Stu, before we get started, a little teaser for everyone. We have a very special guest for next week. Don't say who it is, but this is a really heavy hitter. And so we're going to have him on next Thursday, 4 p.m. And so we want to just put that out there so people can come up there and learn some really invaluable tips about trading.
Bill, I don't think I got the memo on that.
Oh, you didn't? Well, that's why you got him disguised here.
Okay. Yeah, it'll be fun. It'll be a lot of fun to have this guest on, and just it'll be a great conversation. I really urge everybody to tune in and have a fun half hour.
It's going to be an amazing time. So anyway, as always, if you're new to Coach's Corner, we always start off with a little segment called Chalk Talk, which is almost a little bit of a trivia question, give you a little, kind of challenge you a little bit. So what we're going to ask you to do on this one is to jot down your answer. And then at the end, we're going to come back and give you a professional trader's answer, such as Stu, how he would look at this from the floor. So here's what I want everybody to look at. What's the trade?
Bill, that's a lot of pressure, man. I don't know if I can handle that pressure.
I'm putting as much pressure on. I've tried to get you to fail, and I can't. So I'm going to keep upping the ante here.
It'll happen.
No, never. You're too good. So here's the trade. We got the stock at 104. We have the 100 straddle, 780, the 105 straddle, 760, the 110 straddle for 740. These are all the same expiration in the same stock. And the question is, for you as the viewers out there, for the traders, if you saw these prices, what's the trade? Do any of them stand out? Or would you just say, well, I just like the straddle. I think it's either going to be up big or down big, and let me pick one.
All right,
but if you understand...
Let me write this down a second here.
Yeah, go ahead and jot them down.
Yeah, go ahead.
But if you understand options and the whole reason for placing a trade, it's not because of what you think, because it might be priced into there. We've talked about this before. It might be like a football game and saying, well, I think this team's going to win. Yeah, but if there's a 25-point spread against them, you don't want to bet on them. And it's the same thing here with the options. You don't want to place a trade just because of what you think. We have to say, how is it priced?
And how about if it was the Georgia Bulldogs? Did you want to bet on them?
Yeah, exactly. Well, there's a good example. Even there's one where even if they had a big spread, probably wasn't big enough.
That was for you, Ann.
So Ann will love that one. So anyway, here's the setup right there. We're going to come back and give you the answer, or Stu is going to give you the answer. And I'm hoping it's the answer that I'm thinking he's going to give. But, that's what makes a market. Everybody has different
and here's something. Let me just make one comment about that, Bill. My answer is my answer. It may not be Bill's answer.
Correct.
It may not be John Quigley's answer. I mean, it's my answer. So we'll see. We'll go.
But there is something in this setup. It's done intentionally to show that there is a little bit of an advantage if you know where to look. And so, given that, a professional trader should be able to weed that one out. So today. Another cool topic for us, Stu.
Yeah.
And we're going to talk about what's the biggest benefit of a call option. Now, before you start saying, hold on, yeah, I know there's lots of benefits from options. We're going to single out the call option for this one. But if you really had to boil it down, and again, maybe you can even jot this down for all of the viewers out there and traders, what would you say is the biggest benefit of a call option? So Stu, I'm going to start you off with another pressure point here. Give you a few choices right here. Call option advantages. Again, there's a bigger list, but these are the ones we're going to focus on. Do they provide leverage?
I got to tell you, Bill, I never really did well on multiple choice questions.
These aren't multiple choice. This is these are 3 different questions. True or false? You only got 2 choices. Right. Binary.
Okay, go ahead. Provide leverage. Sure. Yes.
Absolutely true.
Yay, me.
One down, excellent. 2 more to go.
But guys, listen, everybody out there, you have to answer these questions too. This isn't really about me. This is about you. How would you have answered that question? Right. And if it was anything other than true, then we have to question it. So go ahead.
We got to talk about that.
Right.
Do they provide downside insurance?
Yeah.
Very true. 2 out of 3, 1 more to go. Now, this one's pretty obvious for everybody. We know this is the big advantage of a call option. Do they lock in a lower purchase price should you decide to exercise?
Yeah, I'm kind of feeling like this is a bit of a trick question, even though you said it's not, Bill. But the answer is no. The answer is a emphatic no.
You're saying no? All right, here we go. Drum roll,
please.
Why
lock in a lower purchase price? No.
Ooh, he got it. So the question is, and I'm sure a lot of you are going, hold on a second. That's the overwhelming advantage of a call. I've got the call, the stock's trading at 120. I can pay 100 instead of 120. What a great deal. Well, what we're going to find out, anytime we use the word benefit in the market, you got to pay for it. And what we're going to figure out here is what is the thing that we're paying for, and where does the true advantage of a call option lie? So first one, I'm going to push you a little bit harder here. You said that to lock in a lower purchase price is false. So let's start there with the market maker. Why doesn't a call lock in a lower purchase price?
Because you gotta pay for the strike price. You got to pay for the difference between the strike price and the value of the stock. It's just a cash number. The market's not here to write anybody a check, guys. It's just not going to happen. The value of the option is going to start at the amount of cash that's embedded into the strike price relative to the stock price. So you got to pay for it. It's not locking in anything. It's locking in the strike price, but then there's a cash portion above that. That's called the intrinsic value. And you're going to pay for that. So you're really not locking in anything other than the value at the current time.
Exactly right. And this is the part that's usually going to shock a lot of people. Now, I made a slide here hoping you would get the right answer. I knew you would, but just to kind of diagram it out for people, let's say that the stock is $120 and we got
way too much confidence in me, Bill.
You've been proven right so far. So to make it easier, we're just going to say these are the only assets we have in the account. We got $10,000 cash. I've got a $100 call that's worth 20 points. Now, just to round it out, we know that each contract controls 100 shares, so that's $2,000 worth. And so the total is going to be 12,000, right? That's what we have in the account. So now, if you sell the call,
this is just $120 stock, XYZ stock, and a call that has a strike price of 100. That's it.
Right. So let's say that somebody says, you know what, I'm just going to sell my call, and I'm going to buy the shares. I want to grab this $2,000 cash. All right, well, what happens? You sell the call, you grab $2,000 cash. Congratulations. But now you got to buy the shares in the open market for $12,000. Yeah,
that's
so
ridiculous.
You're paying $120 if you're going to forego the $2,000. Now, sometimes people say, well, yeah, but that $2,000 offset it. Not really. Cash is cash. It doesn't matter if that was cash, if it came in from the option, if you found it on the sidewalk, it doesn't matter. That $2,000 was yours to spend. You could have bought a car with it. You could have bought groceries with it.
Can I pay my student loan with it?
Can
I pay my kid's student loan with it?
Yes, you can. Probably wouldn't put a big dent in it, but yes, you could. But the point is that it's your cash. Don't let that fool you into thinking that it was somehow discounting the stock. The fact that you rolled it into the same underlying is really irrelevant. You had to pay $12,000 for the stock.
Yeah, it's not the market's cash. It's your cash. You own the option.
Exactly right. So now let's say if somebody goes, all right, well, you know what? I don't like paying the market price. Let me exercise the call and I can pay 100. I'm going to lock in that lower price. All right.
Good
now you're
idea. I'll play cost to carry and all that nonsense. Go ahead.
So you're going to pay $10,000, which is what you have in cash.
Away. Yeah.
Right. And so we say, and look, I've got stock worth $12,000. I've got a $2,000 embedded unrealized capital gain. So therefore, Stu, I've only paid $10,000 for $12,000 worth of stock. But what's going to happen? What's the broker going to do? Call goes out of your account.
Take away your $2,000.
They're going to take away your $2,000. See, that's the part that
you
people
exercise your call. That goes bye-bye. See ya. Bye-bye, Felicia. It's done.
Right. And that's the thing, is you have to sacrifice that call. So look what happened. Whether you close the call or whether you exercise the call, you end up paying the current market price. So there is no discount on the stock. That's a big misperception. Causes a lot of problems with decisions and trades when people think that I've got some kind of a big advantage. What it does
exercise. Go ahead. Sorry. Go ahead. You go.
No, I was just going to say that it just you have to realize that the call is just allowing you to skip forward in time and say, okay, yeah, it was trading for 100 back when I bought the call, but now it's 120. Now I can make the decision if I want to pay 120, but you're not getting it for 100, and you need to understand that to make better decisions.
That's a huge advantage if I get to make that decision later on, isn't it?
It's exactly. Yep. You get to wait and see, or the right to walk away. So if this looks a little odd to you, might be a good reason for saying that you need some coaching or at least some education, please check out marketrebellion.com/get started. All right, Stu, question number 2. Well, if we don't really get this advantage of paying a lower price for our stock by using a call or exercising it, or even closing it for that matter. Another question. Well, then what is the biggest benefit of a call? Why buy it at all if I can't buy stock at a discount?
It's really for your. Bill, did you ever see the movie The Blind Side?
Oh yeah,
Sandra Bullock. Yeah. It's kind of about that. It's about the downside. It's about the risk of the downside. It's the insurance property, the value of the what if I'm wrong scenario. It's the right to walk away. That's the benefit of the call. Another way to say this is if I had unlimited money and I didn't care about dollars at all, and I just didn't care if I lost any money, if I bought the stock, it was just a big game and I really just didn't give two flying what's about it, then what's the vehicle that I would use to take care of my thinking that the stock is going to go up? Well, I would want 100% of the movement. I'd buy the stock.
Sure.
Of course I'd buy the stock. It's going to give me the most mileage. I'm going to get 100% of a move, whatever the Delta move is. Always. It's a run rate of 1/1. But the part that starts to steep into this that very many people, I think, well, I know because I coach them, don't realize is that, well, the what if you're wrong part and what if it goes down? And what if it does go down? Well, the benefit is that you have the right to walk away.
There you go.
And that right to walk away is embedded in the idea that that call can go to zero. And if it does,
or down 10, 15, 20%. Sure.
That's right. So if you bought a $4 call and it goes to zero, then you lost $4. But if you bought a $100 stock and it went to 10, you lost $10. So, you want to be, I think we kind of talked about this at some point. You want to be the guy that loses 100% in $4, or you want to be the guy that loses 10% of 100 or $10.
20, exactly. Right.
Or 20,
it's going to give you, the point to see is that the call option guards the downside. That is really the biggest benefit. We've talked about this before. Calls are puts, puts are calls. Everybody thinks that it's the put option that you buy for insurance, and calls are for speculating that the stock's going to go up. Not true.
It's just the call is a vehicle. It's a vehicle to get on the train. We all want to get on that train. We all want to be on board at 100 and we want to get off at the next stop at 104. That's the train we're trying to get on. The call is a vehicle to do that. And the benefit of that is the downside protection that it provides for me. And it's not free. It's a cost. And the cost is called the extrinsic value.
Insurance policy. I think we've talked about that before where, again, a call is a way to insure your cash against a missed market rally. So what it does, it allows you to not have to pay fully for the stock right now, i.e. guards the downside in case you're wrong, but it doesn't give you a discount if you're right. That's the key insight. So here's a slide. There's a risk graph for long shares of stock, unlimited gains up, unlimited gains down. We've talked about
I knew the slides were coming. There you go.
Many times with Q&A. One of the things that I teach about risk management is to avoid extremes. And stock is as extreme as you can get. You've got 100% to the upside in exchange for 100% losses to the downside. But if we bought the $100 call, this is actually what's called a payoff diagram, where we're assuming that you paid zero. So everything lines up right there at zero. And take a look. You see how that red line overlays the black up here? You are going to capture dollar for dollar to the upside. But that also comes out in the intrinsic value. And that's the part that you have to either sell to close to get it, or to exercise and wave goodbye to it. But take a look at the difference.
Or pay for if you want in. Yeah.
And pay for if you want in. But look at the difference in those. See, there's what the call option does. It's blocking off this potential risk.
That's your insurance.
Yep, that's your insurance policy right there, is that flat line, that hockey stick. And so that's the big advantage of the call. Now, if we didn't want the insurance, I could take the call and sell the put, because this is an embedded put in here, right? We've talked about that synthetically. So if I am long the call and then I sold the put, what happens? We become the stock. And so what is this right here, Stu? If we have call minus put equals stock, that looks familiar.
Looks like the whole put call parity thing, I think.
That's our friend, the put call parity. Special case of put call
Synthetic
parity.
stock, put call parity. Yeah, it all comes out to zero. I mean, this is very important, right? If you have the call and you get, look, guys, go on your platforms. Look at the delta of the call. Look at the delta of the put. Put them together, they're going to be one.
Yep.
And that's the stock.
And that's the stock.
Right? This is synthetic stock.
Right. So if you've got an 80 delta call at the 100 strike, we know that the 100 put is 20. Now, your broker is going to show minus 20, but ignoring the minus, take the 80 and the 20 and you get 100. It's going to behave
you get 100,
like,
which is stock.
Which is stock.
That's right.
So what this shows is if we sell off what everybody else thinks is the insurance, well, now you're back to the stock. And so it is showing that a call has an embedded put option in it. That's why,
which could be a problem when you have a stock that's 300 and goes to 50.
Yep. And you and I, a little side note, we've talked about this before in the movie Wall Street. Remember Gordon Gekko? What was his trade? 1,500, I think, of the July
1,500, July 50 calls.
July 50 calls.
Wait, hold on. What company was that? Wasn't Teldar Paper. It was Anacott Steel.
I think it was Anacott. But here's the thing. If you have inside information.
Yeah, which he had, because he was the inside information.
He was the inside. Why would you buy the call when you're saying, I don't want the downside insurance? He should have taken the call minus the put. He should have bought the call and sold the put and gotten a boatload more leverage.
They didn't consult with AJ on that like they did in Trading Places.
Exactly. Yeah, he would have nailed it. So anyway, so this is a way to show that a call option does have a form of insurance. Now,
absolutely. It's all about the downside.
All about the downside. Another argument that some people bring up about the benefit of a call is they'll say, well, hold on a second. Another benefit of a call is that if volatility increases, I can capture more of the upside, but I'm not really exposed to more downside because I've already bought the call. I've already paid, let's say, $5 for it. So once I buy the call, bring on the volatility. Right? If the current volatility is 20, would you rather see it go from 20 to 80 or from 20 to 10? More volatility is better because our downside is fixed. So the question then is, why does this happen? Why does increased volatility increase a call's price? Well, I came up with a little chart to help us out here, Stu. And these are different stock prices in blue. The first row is for the stock owner. If you own the stock and the stock goes up, you make dollar for dollar. No surprises there. That's what we just talked about. And if it goes down, you lose dollar for dollar. Again, no surprises there. But let's look at the bottom row. This is the 100 call.
Yeah.
If the stock goes up at expiration, dollar for dollar. Look at that, exactly like the stock. That's why those two graphs overlaid that we saw before.
Yeah.
But look to the downside. See, we're not symmetrical. We have the ability to lose less. So we can make money if it rises, but we don't lose money as it falls. Once we've bought that call, it's a sunk cost. We're not going to be exposed to bigger losses. So now let's go back to our put call parity and take a look at this little perplexing point from a different angle here. The call is levered stock. We already said in our multiple choice, it's levered stock plus a put, right?
Yep.
It's stock plus put.
Equals the call.
Let's now make the stock call minus put. So take a look at what happens if the volatility rises. It does help. And then we're going to bring down this plus put over here. But if volatility rises, it does increase the value of our call. But look what it does to the put. It subtracts from it. So these basically cancel each other. We're not getting a benefit from that increased potential range in the stock. But take a look at what we have. We've got call minus put plus put, and that gives us what? Call. I'm sorry, it gives us just a call. So what does it tell us? Where is the volatility affecting the value of the put? The volatility, the reason that a call option goes up in value when volatility rises is because of the put. It's not really because of the potentially increased range. So the thing that you have to understand to make better decisions with trading is that when you're buying calls, you're buying a form of insurance. Now, why is that important, Stu? I know we get this a lot in Q&A. How many times people buy a stock or an option at 5 and it goes to 4? What happens?
They panic and they sell it.
Panic and sell. But what happened? It was your insurance policy coming to the rescue. If you were looking for this stock,
it did what it was supposed to do.
It did exactly what it was supposed to do. If you were buying stock for longer term, use it as an opportunity to say, okay, now I don't need to exercise if it's an out of the money option, but now I know the answer. Now I can buy the stock at a cheaper price. Stick with your plan, stay disciplined. But you can't make those decisions if you don't understand this about a call. Most important aspect of a call option, even though there's lots of benefits and advantages, is that it guards the downside.
And it's the same thing, by the way. It's the same thing on the put side as the stock goes the other way. It's all the same concept.
Puts or calls.
It's all insurance. We can short stocks on the hope that they go down on the future value being lower than it is today. You can use a put for the same reason. And what if it goes up? If it goes up, you're getting nailed 1-to-1. But of course, the put is not going to nail you 1-to-1. You're going to lose less. You're still going to lose, but you're going to lose less. I think, Bill, correct me if I'm wrong, that's kind of why they call it a hedge.
It's exactly what it is. That's why they're hedging tools, because they're forms of insurance. And it's one of the things that we have found. We've been doing this a long time in Q&A, and people always get this wrong. They always think the advantage is about being able to lock in a cheaper price, or that if volatility spikes, you get this bigger range of potential stock prices. It's not really true.
It's a short-sighted view. That's
a good word for it. It's a short-sighted.
You got to get into the level 2, 3, 4, 5. You got to really get into the meat and the bones of it. And you know what it all comes back to? It all really comes back to what is your right and what is your obligation. It always, always, always comes back to that. The put call parity thing is really just about the cash value of the money, the value of the money at the time based on the stock price. And markets are pretty smart. And when you talk about efficient markets, this is the reference. The reference is, well, the market knew the stock was going up. The market didn't know anything. What the market knew was that the value of a stock is what it is, and we can take a derivative and we can value that derivative product in whatever form or combination you make it to be equivalent or very close to equivalent to the value of the stock. And if it's not equivalent, maybe there's an edge.
And that you're actually hitting on which is actually a little bit of our trivia question here from Chalk Talk. But really what we want to show too, really in all of our Coach's Corner, is that to succeed with trading, you've got to get away from this mindset of, here's what I think is going to happen, let me go buy a call. Here's what I think there's going to be a lot of volatility, let me go buy a straddle. You have to say, what's the price? It's not about what you think is going to happen. We have to say, how is it priced? So if these are terms that are foreign to you, and you're going, this is sounding a little weird, another reason why you might want to check into marketrebellion.com/get started. Lots of free stuff on there to help get you started. Now,
go for it. Free is good. It's free. It's for me.
Back to Chalk Talk. What's the trade? So I want everybody else to commit to an answer. You're looking at these three straddles. Which one did you pick and why? And now Drum roll, please. Stu, what's your trade here? What would you do?
I would sell. I would buy the 110 straddle. I'd be a buyer of the 110 straddle, and I'd be a seller of the 105 straddle.
Ooh, look what I had.
That's what I would do. Oh man, listen, hey everybody, Bill and I do not.
These are not.
I can guarantee you, we do not rehearse this.
I really am trying to stump him. I'm trying to stump him.
This is what I would do. I would be a buyer of the 110 straddle, and I would be a seller of the 105 straddle.
Now, why? The bigger question is why.
Well, because one's cheap and one's expensive, man. That's how it works. Buy low, sell high. That's the deal. It shows up in all kinds of different places. Shows up in the extrinsic value column. It shows up in the implied volatility column. It shows up in the where is my insurance column? It shows up in there as well.
Hold on a second. Why is if you're saying the 110 is cheap because it's 740 compared to 760 and 780, but it's also out of the money. The stock's at 104. Why is that? Why are you saying that it's cheap?
Well, the call is out of money, but the put is in the money.
There you go. The straddle is a call and a put. It's
right.
$6
So the straddle,
it's
$6 in the money.
There you go. That's the thing.
It's trading at 740. That means it cost me $1.40 to buy.
Cost you $1.40 to buy that straddle. But then why did you decide to sell the 105?
Because the 105 is $1 in the money, and it's trading for 760. So I can sell $6.60 worth of extrinsic value
and pay $1.40, which gives you how much? $5.20.
$5.20. I mean, that's a $5 credit.
But
and I'm not.
We've got $10 of risk here because we actually. What's the trade here, Stu? See if I can stump you one last time. You buy the 110, sell the 105. What are you going to synthetically be in? And I'm sorry for not giving you a heads up on this.
When you sell the straddle, you're going to wind up with move that over column over there column. You're going to wind up with the 110, 105 bear spread, put spread.
It's a bear spread with 200 deltas in the middle.
With 200 deltas in the middle.
There you go. There's your 520 credit. And then we've got a 10-point liability.
And then I got
gives you 480 maximum
what I say,
to the downside.
520 in credit money that I can work with, and I got 200 deltas. So I'm going to just kind of talk out loud here. So 200 deltas, 520 is $2 and 260 on top of the 105, which gives me a break-even price of 107.60.
107.60.
And and the stock is wrong. I mean, the stock is 104, and I got a 107.60. Break-even price, which means the stock goes up, which is not where I want it to go. I kind of want it to go down if I have a bear spread, and it goes the wrong way. And I got to a 107.60 where I really don't get hosed and lose any money. I mean, it's a beautiful thing.
So it's not saying this is not an arbitrage because we can lose. It's really what's called a pseudo arbitrage or a risk arbitrage, because what he's doing here is he's trading the relative prices. See, he didn't come out here and say, "Oh, I'm bearish." Yeah, he didn't say I'm bearish or I think there's going to be either a big move up or down and let me do a straddle. He's looking at the relative prices. And this right here is what trading is all about. You've got to get this out of your mindset. Here's what I think is going to happen. Let me go buy a call, put, straddle, whatever, because you're not accounting for the price. As Warren Buffett said, price is what you pay, value is what you get. Everybody looks at the option prices, but they never stop to think, what am I getting? So, Stu, very good. I'm going to try even harder, although next we've got our special guest. The following week, I'm going to try even harder. But once again, final closing, for anybody who finds some of the terms that we've tossed around here and the ideas a little bit perplexing and going, this is stuff I've never heard of, this is where coaching can really pay dividends, right? As they say, you can pay me now or pay me later, talking to Mr. Market, and you can learn so much from speaking to somebody like Stu, Elliot, Scotty, a number of our world-class professional coaches. But this is what we talk about every week on Coach's Corner. So Stu, next Thursday, let's hope we can get our super special surprise guest.
Yeah, we're trying hard. Be there, be square. And one more note on that straddle. The fact that you can come up with a break-even point really indicates that you can come up with a put spread price. And when you could come up with a put spread price, if you're kind of tuned into put call parity, you know what the call spread price is. So,
Exactly.
you know,
It's very
if the
good.
numbers were different and the put spread price went to instead of 240, because it was 260 and it's $5 off of 260, so it's 240. Again, I'm talking out loud just to myself, having a conversation. I do that all the time, by the way.
We won't listen.
You know, if I wound up paying 340 or 440 for that put spread, you know, I might think twice about it, and that's going to show up in the relative pricing.
It absolutely will. That is so well said. That's what we're trying to show people here every single week. So again, even if you don't want to take coaching, you can at least get some really good tips here. Coach's Corner every week, Thursday, 4 p.m. Eastern, right on the market close.
Yeah.
And so, Stu, we're going to hope that we get our super special undercover guest. So please join us next week. It's going to be super exciting. And Stu, thanks for making it today. And we'll see you. We'll see you next week. Thanks so much, everyone. See you then.
Take care. See you.